Hello, hi Simple Finance. We are live for day 2. Welcome, welcome, welcome. I hope that you are having a wonderful day. If you're watching live, um, say hi so that I know you're there. If you're watching on replay, hashtag replay so that I know that you watched. I'm just making sure that you can see and hear me. If you can hear me or you're watching live, just say hi so that I know that the equipment is working. And then we can get crack on. We can get started. Bear with me a second. Yep, I think we're live. I think you can see me as well. Okay, awesome. So I just wanted to say thank you so much for joining me this morning. I know as entrepreneurs, as business owners, you have so many things to do. And you spending your time here with me learning about cash flow is an honor. And I hope that I make it worth your time. Today, we're going to be looking at cash in. I've got my notes ready for you for cash in. But before I do, I just wanted to recap yesterday. So yesterday's challenge was basically looking at cash out. Because what I realized, and it was intentional for me to start with the cash out, then the cash in, mainly because a lot of the times we forget that there are two sides of the coin. I know it's so simple and like so obvious, like duh, but it's so easy also to forget some of the things which you take for granted are actually having an impact on your cash flow. So that's the reason why, I started with a cash out so that we can have a look and see, do you really understand how much your business is spending? And then and also it gives us a bit more time because now you have, today and tomorrow, also to think about other things that might come up, other things that, you'll remember and add them to the list. So that is the main reason why I started with the cash out. So today we're looking at cash in, which is usually the most exciting bit. Everybody wants to get money into their account. Everybody wants money in their account. Everybody loves to have an extra zero in the money that shows up in the account. But how do you make sure it actually gets to your account? So I wanted to have a look at, those things. And by the way, when you did your cash out, sorry, just to go back a little bit, when you did your cash out, were you surprised by the number that you got? Were you surprised by, oh my goodness, I didn't think it was that big, or it was that small, or have I forgotten something? Or just let me know whether you were surprised or not, or whether you already knew it, and there's nothing that surprised you. So moving on for today, cash in. I wanted to start first by defining the difference between sales and cash, because sometimes people think it's the same thing. When you hear someone telling you, oh, cash flow is a problem, sometimes it's difficult to understand whether are they talking about that they're not selling, or are they talking about that they've sold and that the money hasn't come into the business yet. So it's important to differentiate the difference between cash and sales. So when we start with cash, let's start with sales. So there are different ways you can sell. You can sell something by, let's say supermarket. So you go to the supermarket, you buy something, and then you get the goods. So that's cash on receipt. So you've received the cash and you've exchanged the goods for money instantaneously. So if your business is that kind of business where the customers would come and they buy and they pay before they leave, then it's easy to understand why you confuse the two, because they're basically the same. When the cash lands in your account is the time when you make the sale. But not all businesses are like that. There are different businesses whereby you, especially many SMEs, many small businesses will be selling on credit. Yes. So yes, absolutely. Sales and cash are not the same thing. That's absolutely true. And it's so easy to differentiate the two. So especially if you have, if you have a business that, you collect the money on delivery, or you collect the money, you get a deposit fast. Let's say the customer, let's say you're a baker. It's better to explain using an example. Let's say you're a baker. You've made your cake, or rather someone rings you, ding, ding, you take the order. And then after that, you're like, okay, yes, what would you like today? They say, oh, I want, X and Y, I want you to make me, a wedding cake. And then you're like, okay, I will require a deposit of I don't know, 70%, 60%, and then the remainder you pay on delivery. They're like, okay, that's fine. Now, when you're looking at your cash flow in such a situation, you would get the money upfront before you make your delivery. So the cash flow is that the money has come in before your product has been delivered to the client, and then later on you would deliver the client to the client, and then you get the remaining of your money for your sale. So your sale is complete when you deliver your product. So that's another way that cash comes into your business. So remember, we are looking at cash flow. At what point the money comes in your business? It's not that you made the sale, because you made the sale as soon as you accepted the order, and you made the sale for the total cost of the cake when you agreed that, you know, this is how much I'm going to charge you for the cake. So that's when you made the sale, right? And the sale would be the total cost of the cake, because that's what you're expecting to come into your business. But when you look at the cash, you get it in chunks. You get a chunk when they do a deposit, and you get the other chunk when you deliver. And so it's not just in terms of commitment. The deposit is great because you see that your customer is committed, and you are now also committed to give them the product, to deliver the product to them. So in a way, it's also, in a way, when you deliver your product, that's when you get your final payment. So that's another way that cash flows into your business. The other way that it flows into your business is when you sell on credit. And this is where most SMEs, most small businesses fall under, where you sell something on credit. Someone says, I'll buy it from you and then you pay me later. Okay, so you sell it to them. Literally, you sold it because you no longer have it in your stock. And then they pay you either at the end of the day, or they pay you in 7 days, or in a week, or however long. Now, if you're a small business and you have clients who are corporate clients, like big contracts that you deliver, the challenge you find is that those big companies already have their own payment terms. And remember this word, payment terms, because it's such a crucial thing that I want to discuss today. So they have their own payment terms where they say, actually, we're not going to pay you now. We're not going to give you any deposit. We're not going to do nothing. What we do with our suppliers, because now you're a supplier to them, with our suppliers is that we pay them after 30 days, or we pay them after 60 days, or we pay them after even 90 days. I've seen some of them who are like, say, we're not going to pay you now. We're going to pay you in 90 days. But they tell you at the beginning, those are the payment terms. And some of them are great because on 90 days guaranteed, the money will turn up in your accounts. Other times it's crazy because you're like, oh my God, it's been 90 days. You're still not paid me. So you have a long period of drought. Yeah. So when you sell things on credit, it's really, really important to remember that, yes, it's great that you've sold something, but also bear in mind the impact it has on your business, because you will have a period where you don't have any money to go and buy more stuff to sell. And guaranteed, as a small business, the challenges you find is that you don't have the bargaining power of these big companies. You don't have the bargaining power of the corporates. You can't go and tell the person that you're buying from, I'm not going to pay you today. I'm going to pay you after 60 days. They won't just sell to you. They'll say, no, on your way. I'm not selling anything to you. Goodbye. See you later. Because you don't have the bargaining power. But if you are bigger, and if you could buy bigger, in bulk, then maybe you would have that bargaining power. So now it will depend on the relationship that you start to build with your suppliers and the trust you start to build with your suppliers, if they can sell things to you in credit rather than selling things to you for you to pay immediately. Because that is what, when we start saying that cash, without cash, your business can't function, that's what we mean. When you have a period of drought where you literally have no money in your business, that's when you can't buy any more things, because your suppliers will not sell things to you on credit because you're not big enough. You don't have a bargaining power. They don't really know you that well. You're new in the market. And as I shared yesterday, the statistics of small businesses, 70% of them fail after 5 years. So they're cautious in how they do business with you. And guaranteed, many of the suppliers are also small businesses, so they also want their money quickly. And that's what small businesses do. They want the money in quickly. And so it's hard for you to find somebody who will sell things to you on credit. So that means that you have to have the money with you in order to buy those things. And then now, if you have a customer who's a big organization, they come with their own conditions and say, you know what, we're not going to pay you only after maybe 90 days. And then you have this long period of drought where you had to raise the money to go and buy the thing that you were selling to this big company. And now you have 90 days, 3 months, almost 3 months of nothing. Nothing is happening because you have no money. And that's when you start feeling the crunch because of the payment terms of your customers and payment terms of your suppliers, which are most likely cash. Cash. When you buy, they want the cash immediately. So what I want you to think about your business. Do you have payment terms for your business? When you sell things to your clients, do you know exactly how much or how long you're going to give your client to sell? That's if you sell things on credit. The best way or the best model is if you can get your cash on delivery. If they can even pay before a deposit, that's great, because you can use that money now to go buy more product, to find more clients, because it's the fuel in your business will be the cash. So if you don't have that, if you can't get the cash in, that means that the fuel, that's the engine that's moving your business, is basically you have no fuel and you're at a standstill. And that's what you get. That's what we call cash crunch. Yeah. So think about, what are your payment terms? Do you have any payment terms? If you don't, then we need to start thinking about putting some payment terms for you in your business. People pay cash. Is it standard for everybody, or is it some people pay cash on delivery and other people get 7 days, other people get 2 months? Is it standard? Because if you standardize it, it makes it easier for you to predict when the money will come into your business. So it makes it easier. And all this we're doing is working out your cash flow, your cash flow forecast, so that you are not at any point without any money. Yeah. So that's what we're working on. So what are your cash payment terms? Is it 30 days, 45 days and are you doing it intentionally? Because if you're not doing it intentionally, there's something that's a bit of a miss. It means you don't understand your business really in order to intentionally drive your cash. And these are things that you need to start putting in place. Now, one thing I wanted to say is, if you have big clients like corporates, the risk many small businesses fall in is if you have one big client and they are the only source of income in your business. There's a huge risk in that, of having just one big client. It's better to have many smaller clients and have money trickling in than have one big client and if they basically control your business. If they pay you, then everything is fine, everyone's happy. If they don't pay you on time, oh my goodness, that's your business is in big trouble. So think about the risks that you have in your business. Can you look for a few smaller clients who will help you just keep the lights on? Remember yesterday we had a look at your cash out, or everything that you're spending in your business. There are things that you have to pay for every month. If you have a client who's paying you in 90 days, what's going to happen over those 3 months? Your bills are just going to stack up. And we don't want that. We want to be able to bring in money so that you can pay every month, whatever it is that you need to pay. So if you have big clients, think about getting smaller ones as well. Don't just focus on the big ones. Get smaller ones as well who keep the lights on, who will help you keep the lights on in your business. Another thing I wanted to talk about is when we look at cash in, again, looking at the differences between sales and cash. Cash is how can I say it? It's so easy. Cash is the liquid that makes your business function. Now, if you're putting it in one place, if you have a bank account where all the money comes in, it's easy for you to track what's coming in and what's pending and things like that. If you use mobile banking, if you have a pay bill number that all the money comes in, then that's great. You can get the money coming in there and it's easy for you to track it as well. Now, the way you get the money in is through invoicing. So invoicing is when you send your clients the bill. Now, one thing I found with many small businesses is, especially if you do business with your friends or family, is that you don't send the bill. And what that ends up doing is now two things. One, you haven't got anything to show them and to keep reminding them. Because when I get a bill, I know how much I need to pay. And if it tells me when I need to pay it by, I know when I need to pay it by. So your payment terms, again, so important because that goes on your invoice. And when you send it, it's so important because your client receives it and then they know when they need to pay you by. Now, that's one thing that small businesses don't do, being consistent with your invoicing, making sure that you send it out on time. Don't wait a whole week before you send it. Send it as soon as you made the sale, because as soon as you send it, that's when the money starts coming in. And another thing I find about invoicing is that if you don't send the bills to your one thing I find about invoicing is that it requires you to keep track of what has been paid and what hasn't. Accounting softwares are fantastic with this because when the money comes in, you know, you tick that invoice being paid, that one's been paid, and that's done automatically for you on the system. But if you're doing it manually, or if you're relying on your memory, it's so easy to forget, or one invoice to slip and another one to slip. And you'll be like, I'm sure I sold more than this, but why is the money not coming in? So that's where invoicing comes in. Not only does it remind your customers how much they owe you when they need to pay you by, it's also a way for you to track your income and make sure that the money is coming in. Another thing that I find in many small businesses is there's this mindset of I don't know, for some reason you send an invoice and then you feel like, oh, they haven't paid, should I chase, should I not chase? Maybe they'll think I'm desperate if I keep chasing it. There's a mindset to it when it comes to money, and a mindset to when it comes to talking about money. If you find yourself that you don't want your clients to think that you're desperate, you don't want your client to think about X, Y, and Z about you, you have a money mindset issue, and we need to address that. The process that you need to approach when it comes to money is that the business is the business, yeah, and the money for the business is the money for the business. So if it's due to be paid next week, you need it in order to pay your bills X, Y, and Z. And that's why you need to chase it. You need to make sure that you're chasing. You need to make sure that the money is coming in. If you're not chasing, the money is not going to come in because your client most likely is going to think, oh, maybe they don't need that money. Oh, maybe I can stretch another week. Oh, maybe I can just see if I can pay them. If they don't make noise, then I won't really say anything. So you really do need to make sure that you chase your client just from a professionalism standpoint. You're being professional, so you've sent an invoice and you're chasing it. It hasn't been paid. And if they, you chase it a day, if they haven't paid, you chase it 2 days, a week. The best way is you call them and say, hello, this invoice hasn't been paid. When are you paying it? Develop that relationship so that you are at the top of their list. When they start making the payments, that you are at the top of their list and they know that you need your money. Because again, it's so easy to fall into, oh, I don't want them, just mindset thing. Oh, I don't want them to think I'm desperate. I don't want them to think that I really need this money, but you really do need this money. So don't worry about what they think about you. Don't worry about such things because it's your business and you need the money to come in. So that's what I wanted to bring up today. I have a task for you for today as well as, and then tomorrow what we'll do is that we'll put the two together. So in the same way that we did yesterday in the money out, where we had a sheet of paper and you divided it into 13 columns, do the same for the cash in. So get a sheet of paper, divide it into 13 columns. The first column will be description for the money that is, your client. So if you have regular clients who are always paying you, put them on that list. Number 1, 2, 3, 4, those are regular clients. And then how much do you sell to them regularly? Put that amount. Do they pay every month? Put that amount and put when they actually pay, not when you actually sell, especially if you're selling on credit. When they pay. So if you sell in January and they pay in February, you put the money in February. If it's a corporate client, it's a big client, and they have like 60 days and you sell in January, just know that the money is not coming until March. So you put the money in March. So that's how you start developing your cash flow. If you are, and now you'll start trying to look at the ballpark, to look at the averages in your business. If you sell, you sell, like, I go back to the case of cakes. If you sell like 5 cakes, a week, You can average it and say it's going to be 52 weeks in a year, maybe, just guessing, 52 weeks in a year divided by 12 months. Then after that, you have how many you sell every month. When do they pay? They pay deposit first. So you put the deposit when they order in January, you put that amount. Then the rest of it is going to be paid 3 months, or 2 weeks from now, you put it in the same month or the following month. So you can have that. Now you'll start projecting when your money is coming in. And then what we'll do tomorrow is that we will look at the two together. We will look at the two and see, is the money coming in enough to sustain your business? Because now this is where we get the cash flow. And what many small businesses fail to understand, or many small businesses get confused is, number one, not having clear payment terms. Yeah, so payment terms, when is the money going to come in? And that's determined by your payment terms. If you're going to say it's 4 days, or if it's going to be a month, stick to it and make it standard for everybody. Yeah, because if you don't, then you'll have sporadic money coming in. The other thing is invoicing. As soon as you make a sale, send the invoice immediately. Don't wait. Oh, I don't want them to think I don't know, I just give it to. No, as soon as you make a sale, send the invoice so that it's fresh on their mind. And if they can pay a deposit, that's awesome. And the other thing is, I find is sometimes small businesses, we don't ask, especially if we're working with a bigger client. You can ask them, please, can you give us a deposit because we have such long waiting times? Could you at least give us a deposit for this much, or break it down, pay us a little bit then and a little bit then, because we're a small business and this is really going to leave us cash strapped. It's worth asking the question. You never know, they could say yes, but if you don't ask, the answer is definitely no. So those are the main things that I would like to let you know. And another thing is, don't just believe that if you're selling on credit, like any sale is better than no sale. That's not always necessarily true. If you're selling on credit, you need to be careful who you're selling to. You need to have a think, speak to some people and see whether they're good payers. If you know someone is not going to pay you, don't sell to them, because sometimes we feel as though, now they owe me. You might end up spending so long chasing them for your payment. And if it's a good that they've already consumed, you'll never get the money back because they've already consumed it and there's no way you're going to get your money back. So depending on the industry that you are in, have research and try and understand your clients. If I'm selling them on credit, guard your credit sales, because it will impact when the cash comes into your account, and also it will impact, if you're not clear on your payment terms, it'll impact when the money comes in. And you don't want to just have credit sales just for the hell to say, for the hell of it, to be able to say, oh, I've made sales, because that, you might as well just have given the things to them for free if they're never going to pay the money. So yes, it's great to do credit sales because you're helping those people by giving them a product that they're going to pay for later. But at the same time, you need to think about your business. Is it really worth it for me to sell this thing on credit when I don't even know if I'm going to get the money? Is it the fear of missing out? I call it the FOMO of sales FOMO, the fear of missing out on a sale. Is it worth it to me selling it on credit? It's just something that you need to think about. And I think small businesses, we don't talk enough about this, because we always feel as though if someone owes you, then it's great because the money is coming. You just always believe the best case scenario that the money is coming. But what if it doesn't? What do you have in place to cover that? So that's all I have time for today. Thank you so much for spending time with me. If you're watching a replay, #replay. And remember the homework, the task that I've set for you is to just go and think about everything that you sell in your business per month or per year, and go and put it again in that same table. This is a bit of a hard task because it requires you to just be a bit theoretical. It doesn't have to be very scientific, but theoretical in your mind, so that you can start looking at a way to forecast in ballpark, or in general. Are you bringing in more money? Or in general, are you losing out? Are you spending more money? So it's not going to be scientific, straight to the, to the zeros, as you can be in the expenses. Because in the expenses, you can be explicit and you can be very specific, especially for the fixed expenses. But in the income, you just have to use an assumption and say, you know what, maybe I think this is what's going to happen. And if you're a seasonal business, like if you have seasons that boost your sales, for example, Valentine's Day, if your business benefits from Valentine's Day, then you you increase your sales during those specific months when you know that your business will get a boost in because of the season. If you're, I don't know, if you're a touring company and in the summer, you know, many people come in and tour, it's the same thing. You increase your sales during those seasons when you know that your sales are going to go up. So yes, so that's all I have time for today. Thank you so much for joining. I hope it's been of value. And I will see you tomorrow when we put that together for cash flow. Thank you very much. Bye for now.